Hello and welcome to the latest in our series of Cracking the Currency Code webinars. We've just gone live, so we're going to give people a few seconds to log in and get started. We'll be ready to go in 20 seconds or so. Okay, good stuff. It looks like we've got a good number of people with us today. So thank you for attending. So a little while ago, we asked our LinkedIn community what to cover next in this series of Cracking the Currency Code webinars. And today's topic really was the big one that most people voted for. And that is, can you really time the currency market for business transactions? And should you even try, right? So I'm thrilled to be joined today by two well-known names in the industry who will give us their expert insights as we try to answer that all-important question. We'll each give our opinions and thoughts. So this is the format for today, no slideshows, plus one piece of compelling evidence, a chart or something similar to back up our claims. I don't know what Craig and Mike are going to bring to the table, so this should be a fun discussion. And then we'll see at the end whether we agree or not, or whether we even come to a conclusion that's definitive. So to introduce my colleagues, my panelists, from London, we have cross-asset market analyst at TraderX, and in fact, our own Oku Markets weekly columnist, Michael Brown. If you don't subscribe to our weekly currency market outlook newsletter, then you're missing out on Mike's really fabulous chart of the week column, where he brings one interesting and important topic for a weekly deep dive. And joining Mike from the United States, we have Craig Haymaker, a CPA, that's Certified Public Accountant for the Brits, and risk management executive with more than 16 years of experience in capital markets, 7 of which dedicated to audit and assurance, and the remainder focused on accounting and treasury-related functions. So with Craig being a real expert in financial risk management, hedging strategy design, financial instrument valuations, and complex accounting, he's going to be the voice of, I think, the accountant and the voice of the treasurer as well on this one. And finally, I'm your host, Harry Mills, founder and director of Oku Markets, a London-based currency management firm. We serve SMEs, multinationals, and private clients. So intros out the way, chaps. To kick things off, we'll tackle that main question. Can you time the currency market? Craig, let's start with you and let us know your compelling evidence as well.
Sure. Well, I appreciate it, Harry. Thanks again for having me. So my answer might surprise you. The short answer for me is yes, but a bit more context is needed to better answer the question, I think. So first of all, I'm not approaching this question from the perspective of a speculator or a hedge fund, right? I'm giving it from the view of executing a hedge in support of some risk management strategy. Second, I think the question also implies that there's some economic or strategic benefit to timing the market, right? Optimizing price or rate, improved liquidity, better trade terms, etc. Third, and on the topic of strategy specifically, I think a company's risk management and hedging strategy will dictate whether or not timing the market is even allowed, right? Let alone a prudent business decision. And I'll expand more on that a little bit later. Now, for most companies launching a hedging program, it involves the following sequence of events, more or less, right? Establishing governance, creating policy and procedures, clarifying roles and responsibilities, getting trading partners and counterparties established, right? Putting that framework in place. Now, invariably, there's an approval from senior leadership and authority is given to trade. Once that authority is given, choosing to wait a day, a week, a month, or even a quarter, that matters. Simply by virtue of the passage of time and just given how risk changes over time. So with this in mind, if you wouldn't mind pulling up the chart here, I wanted to talk about value at risk, and I'm going to get a chuckle from some of my quant friends who, might think it's striking that an accountant is coming out of the gates with VAR for discussion today. But I bring you VAR in fall colors, gentlemen.
Okay. Are you going to give us a quick definition of this, Craig, for the uninitiated on the call?
Absolutely. So, VAR is a useful metric to show how time affects loss potential. VAR estimates the maximum loss potential of a portfolio over a given expanse of time at a given confidence level. So what I'm showing you here is, so for example, I just drew up, hypothetical. You're a USD functional entity with $10 million in euro exposure, call it revenues. And so I have FX risk here that I'm thinking about. So, in this instance, what I'm showing you is that an entity with this kind of exposure, over a day, 1% of the time, my losses will be at least 100K. Over a week, at least 300K. Over a month, at least 650K. So, yes, it's possible to time the market, but when you look at VAR and consider how loss potential changes simply with time, and again, these are static inputs, right? We're not even considering the changing risk dynamic over time. So it's possible to time the market, but when you consider opportunity cost, how risk changes over time, and how far off the mean you can get when you wait, that begs the question of, well, is it prudent? Should you do it? Which I know we'll get to in a moment.
So if you have, a 5-day hedging window, Craig, say it's the first week of the month or what have you, what you're saying here is for this fictional 10 million euro exposure, there could be a loss of up to $300,000 if you get it wrong, right? Is that kind of what you're saying?
Yeah, that's exactly what I'm saying. And these, these aren't, this isn't a guaranteed or predetermined outcome, right? We're talking about potential. And as you increase time, as you expose yourself to a broader window, you're exposing yourself to the potential for greater adverse movements in the market.
Okay, excellent stuff. So it is possible, what you're saying, but this is the potential risk. I guess the flip side is this is the potential gain. Would you agree, or?
Yeah, I would agree. But again, context is everything, and it really depends on what that risk management strategy actually looks like. I don't want to steal too much from later on, but I'll leave you with
good.
that.
It's a great start, and thank you for that. So really interesting perspective, Craig. Let's hear now from the voice of the market analyst, the voice of the trader, the voice of the investor, Mike Brown. How do you read this one? Is it even possible?
Well, I was going to say I'm having to put on quite a few hats there after that jam-packed introduction. So thank you for that, mate. But may I first apologise for my eyes darting all over the place. Someone decided to arrange this webinar for right in the middle of a central bank meeting out of Europe. So forgive me for being slightly distracted just now. I think it's an interesting question. Can you time the market? Obviously, we'll get into that discussion in a short while of should you try. But I think the question of whether you can time the market, I mean, yes, you can. Fundamentally, is the simple answer. I think really the way I would look at things is the degree to which luck actually comes into the equation, because financial markets are by no means a simple endeavor. I think everyone on this call, and certainly us three on the panel, have been around the block long enough to know that. And there's plenty of moving parts when it comes to the financial markets. And I'd be greatly obliged if you could bring up my chart here that we've handily resized so that everyone can see it. And this looks horrible, I'll be honest, and that's sort of the point, really, of what I'm trying to get across. So what we're looking at here is the correlation between the dollar, the US dollar, and various assets that we tend to see as drivers of the currency. So we've got 2-year Treasury yields, we've got 10-year Treasury yields, we've got a couple of gauges of risk appetite in the S&P 500 and gold, and we've also got WTI crude, because, of course, the United States is now an energy exporter, and there are some out there who are saying that the dollar has actually taken on its place as a commodity currency.
And Nick, just to quickly interject there, you're using the US dollar index, the DXY here, aren't you, for a comparison? So
I am.
I'm sure you're going to tell us, but these 5 charts you picked, we've got some red and some green, right? I mean, I'm sure not everyone on the call will be able to get that. Could you just give us a quick overview of what we're looking at precisely?
Yeah, absolutely. So the way these scales work is the closer to one the correlation is, the more positive that relationship is. So one is a perfect positive correlation. They both move bang in line with each other, and -1 is a perfect negative correlation or inverse correlation. They both move perfectly in the opposite direction to each other. Now, you're never going to get that in financial markets. So anything around sort of 0.5 is generally pretty strong in terms of a relationship. The reason I want to bring this up is twofold, really. One is to show the number of moving parts that are involved in terms of actually trying to time the market. If you want to try and time the direction of the greenback in this instance, you need to have a view on where the treasury market is going. You need to have a view on where equities are going, where commodities are going, where gold's going, where oil is going. But secondly, the speed at which these drivers change over time. You can see on the chart there have been periods over the last 3.5 years where treasuries have been driving the dollar. There have been periods where gold has been driving the dollar, etc. And for someone, even for myself, who I did it 15 hours a day, 5 days a week, trying to second guess exactly what's going on and what's going to happen next is very, very difficult. Even though I like to think that it's sort of more of an educated guess than anything else. For a financial director or a CFO who financial markets and foreign exchange is a relatively small proportion of what they're doing in terms of the greater scheme of work, trying to stay in tune with it as much as we are here and work out exactly the mechanics that are driving the market is very, very difficult indeed. And I think that's why, yes, you can time the market, but we'll get on to whether you should or not in a moment. And I think just one other thing I wanted to mention before we do move on, obviously you want to share your thoughts on this topic, is I had a look at Bloomberg. So everyone submits their forecasts to Bloomberg on the sell side, investment banks, all the rest of it. And you can obviously compare those to how the market actually panned out. And if you look at the third quarter, I'll have to refer to my notes here, the end Q3 consensus for sterling dollar for cable was 128. We actually ended the quarter at 122. And when you're looking at most on the sell side getting things that wrong, I think it's very, very difficult for other people to get it right.
Wow. So the so-called experts find it difficult to get it right, as you said. I think I have that chart, so perhaps I can bring it up later as I export it to PDF, Mike. But also,
sorry, I've rather sprung that on you now.
Yeah, apologies. But you also mentioned luck at the start, right? So are you an advocate? Are you a believer in random walk theory, that markets move randomly?
Not particularly, but I think you do always need to be attuned to the risk of black swan events or unknown events suddenly sparking a significant move in the markets. I mean, just think recently, for example, the massive rise in geopolitical tensions in the Middle East, the conflict between Israel and Gaza, not necessarily related to the foreign exchange market, but like to take a cross-asset view of things. We've had a big rally in gold, we've had a big rally in crude prices, and that's a result of something no one had really foreseen happening before the missiles actually started flying and before the headlines started crossing about that event. So I'm not a huge advocate of the idea of this sort of random walk theory, as you said, but I think there are events and there are moments in financial markets where it is simply a sort of question of fortune. If, for example, you were long crude and we saw a big rise in geopolitical risk and that was priced in, that's not through any sort of analysis that you've done. That's purely the market working to help you out, or the geopolitical situation helping you out.
Yeah, and Mike, just a comment. I appreciated on the chart how you showed correlations in there, right? And coming from my background, is to think about the way treasuries typically, treasury functions typically think about correlation and regression. And I have my hedge on this side, I have my risk exposure on the other. I need to prove a tightness of fit and proving that I'm actually achieving offset and cash flow or variability and value, or whatever the case may be. But showing those correlations at minus 0.17, 0.34, 0.40. In my world, the significance of this correlation outcome needs to be 0.8 or greater to prove that the hedge is effective. So you bringing up this chart just goes to show in prominent macroeconomic figures and inputs that are intended to inform some orientation on what the market's going to do. But you see these correlations as not being very strong at all. And yeah, it makes you wonder who does get it right, right? And fortune and luck are such a significant aspect of this. So I appreciate
how it changes over time as well, right? I mean, we talk about the dollar moving in lockstep with treasuries at moments recently. I mean, that surely, well, we can look back 3 years on the first row there. That hasn't always been the case, and it probably won't be over the next couple of years as the Fed starts to cut rates. But this isn't a markets webinar, so we're going to park that there before we get too heavy into markets. And so, really interesting point there, Mike. And from my side, again, it might surprise you to learn. I agree. We can time the markets, but how and why? So here's my evidence, and there's a lot going on here. So let me talk you through what we're looking at. So every week, we publish a weekly price projection for various currency pairs here at Oku Markets. So I've put the little table in the bottom right for this week's price ranges, and you'll notice that this is a range. It's not a one directional rate. We're not saying the rate is going to go to this point. We're going to say it's going to trade between these ranges, and we do so with a 68% confidence and a 95% confidence. So what I've done is I've plotted all of these weekly predictions, if you like, from the start of this year for sterling against the dollar. And we can see the light green middle band is the 68%, and the slightly darker shaded band outside of that is the 95% band. And then I've plotted the daily high and low for sterling dollar in that each week. And it's remarkable how often markets stay within those bounds. But we can see where there's little moments where the market will go beyond the 65% and into the 95%. And then, in fact, if we look at sort of 20th, 24th of July, the high actually broke through into what we'd only expect to see 2.5% of the time. Those are really good signals for buying and selling. So what I would suggest is, can you time the market? Yes. And if I were to do it, I would do it by looking at our weekly price forecasts, and I would potentially look to place orders around those levels. But I would ask these questions first. Is the market trending? If it's going against you and it seems to be trending that way, it might not be a good idea to seek a slightly better price. Is the rate at an extreme? That could be a good signal. Do you have a few days in a window? Because markets move around a bit, 50, 100 points intraday trading range is fairly common for most currency pairs. And is the current rate within your budget if you have such a target rate? The answers to those questions should give you a clue as to whether it's worthwhile placing an order or a target, an order to call. And the reason I would use this is because it's proven to be very accurate, as you can see, but I'd also use it alongside other indicators, my favorite being really straightforward pivot points with supports and resistance, and they line up really neatly. The final thing I'd say before I ask you guys for your opinion is this is not based on emotion or opinion or gut instinct. This is statistical. It's based on market volatilities. So there's some statistical scientific base to this. Craig, I can see you're anxious to make a point. What do you think?
Well, I was just going to remark that it is striking to see just how often these two standard deviation moves are happening. And again, just lending itself to a perspective of, why wait?
Why wait?
I mean, and again, it's all about context. I think about simply mitigating variability in my exposure. It's just, you just don't know.
Yeah, you just don't know. Okay, good stuff. So I think we've answered the question, can you time the market? It sounds like there's a consensus that we can, and there's different mechanisms and ways of doing so. Before we move on to should we try, I wonder whether, Mike, have you got any examples of when maybe a business client or someone else, an investor, has tried to do this and it either has or hasn't worked, from your experience over the years?
Yeah, absolutely. I mean, obviously, I'm not going to go into too much detail for various professional and commercial sensitivity reasons, but yes, I think we've all seen numerous examples in the past where I think a particular problem, and you mentioned, and I'm glad you brought it up, and your volatility chart. The implied volatility is actually something that I use in my own process, looking at trading ranges for the week ahead. Admittedly, I'm a little bit lazy, so I only do them with one standard deviation of confidence rather than the two that you tend to use. But nonetheless, they are a very, very key input. And they do take emotion out of the equation. And I think, thinking back to my days when I was involved much more closely with corporate foreign exchange and institutional foreign exchange and risk management than I am now, I think emotion was the key driver when you did see what I would ultimately call a mistake when managing foreign exchange strategy. The number of times you would see, for example, a dollar buyer and cable would break below 130, which at the time was a good rate to be buying your dollars, to be selling, and you then suddenly go, actually, well, I think it's going to keep moving in my favor. It's going to move another 5%. It's going to move another 10%. And then you'd be at a point 3 months down the line where you're ringing up and going, you've got to do the transaction because this is the time limit that you've put in place, and actually because of the emotion that you let run away with itself, and because of ultimately the greed that got involved, we're now 5% offside compared to where we were when we last spoke. And I think that just speaks to the need really to, as much as possible, take emotion out of your dealings with the financial markets and really try and stick to a defined risk management strategy, which I'm sure we'll get onto in a short while. And if you have a budget rate and you achieve that budget rate, and maybe even if you achieve a big figure better than that budget rate, stick to it, lock it in, take advantage of it. Because when you sat down with your board 3 months prior and agreed that budget rate, it was good enough for you. It should still be good enough for you now, no matter whether the market is likely to move further in your favor or not. I think the key should not be trying to secure further favorable movement or further upside. I think the key in this example should very much be trying to mitigate and manage risk first and foremost.
I couldn't have said it better myself. You're excellent advocate for what we're doing, Mike, for sure. But taking the emotion out and trying to take away the Gordon Gekko opinions from around the boardroom, I guess. And I've seen similar situations as well. And one thing I would add is those round number rates are very appealing to people. But the reason I use the projected rates is because it's based in statistics. You might say I want 125, but we're pointing to 124.12, for example, and that could be the difference in you getting a trade done or not. Craig, how about a quick 30 seconds or so from you on this topic? Have you got an example to share?
Yeah, I mean, in terms of when it worked, I can think of a client I had that was a financial institution. They received board approval to trade in Q1 of 2020. They dragged their feet. COVID hit. Rates fell off a cliff in Q2, and their languid approach to hedge execution proved beneficial. But I can think of far many more examples of situations where it didn't work. I was working with a US-based entity, European sub. They held off trading in Q3 21, pushed it out 6 months, executed in Q1 22. Euro USD dropped about 18%. So they got bit. I can think of another company which maybe isn't as germane to currencies, but they were an OEM, an original equipment manufacturer exposed to steel. 2019, steel was trading about 725.85 range, and then price just shot up to 1900 in 2021 and just got pummeled. I'm a big proponent of when you get authority, you pull the trigger and then move on.
For sure. And I think to your point about the COVID, changing prices, for those of us who are working on the day of the EU referendum in the UK, I remember being up at 4 a.m. sprinting across Finsbury pavement to get into the office, and there were people overjoyed and people in tears because they'd missed out. So for sure, we're coming up to 5 minutes or so for time. So this brings us quite nicely onto, okay, we think we can, but should we try? why don't we go to Mike first on this one? So you gave us a fairly compelling case, Mike, for luck and that you can time the market, but should you try?
Well, I will keep things relatively short and sweet, which some may say is a change for me. But in the interest of time, I think I laid out the rationale behind and the logic behind this answer just a moment ago. I think in this instance, absolutely not. Certainly not with the full amount of your FX exposure. I mean, if you were absolutely desperate to try and have a little bit of exposure and try and time the market in some way, shape, or form, then maybe do so with a very, very small proportion of the exposure that you have. But by and large, I think a corporate foreign exchange requirement, the focus should be on risk management and risk mitigation, and doing so with an objective of achieving your desired budgeted exchange rate. And as and when that is available, I think it's prudent for treasury departments to put in place strategies, whether that be forwards, options, limit orders, a combination of all of them, in order to achieve that and secure that for the budgeted period. So yes, you can try and time the market. Should you? Absolutely not.
Absolutely not. Well, I think from my side, as I said earlier, it's definitely possible to look for trading opportunities and execute against them using statistical and technical indicators and methods as we described. But most financial decision makers that I work with prefer a straightforward currency process. And I use the word process very, very intentionally because that's what it should be. They don't want to be spending lots of time thinking about the market, or in their words, being a trader. People say that all the time. I'm not a trader. So in my view, if it makes sense within a window of a few days, if there's value to be made by extracting 50 points or more from intraday currency fluctuations, and it's within your policy, within your budgeted levels, then fair enough. Otherwise, I think the whole point of a hedging strategy within a policy is to work to that framework that delivers the highly predictable outcomes. And by adding in some elements of market timing, you could actually be working against that policy. So I'm a little bit on the fence. You could do if it makes sense in terms of timing and the levels, but actually 80% of the time, I think you should just get on with it, stick to the policy and get on with your real business. Craig, last half a minute or so for you. How do you see it?
Yeah, I echo the points made. What I would clarify is optics matter. And when it comes down to it, we don't want to put ourselves in a position where we're at risk individually. We don't want to put ourselves in a position where our company's at risk. To your point about policy framework, Harry, right in there, this is how I'm going to approach hedge execution. I'm going to give 3 days of analysis. I'm going to pick and choose my points. I'm going to operate within a window of variance to be able to execute, but be transparent about it. So if you lose a few points because you waited, it's not a big deal because you followed that process. Mm-hmm. And I think that that's just a key piece to it. But yeah, at the end of the day, if I'm a trader and I get approval to trade and I come back a month later to my boss and I say, hey, I saved us 2 points, they're going to look at me and they're going to say, why the hell did you give me exposure for a month?
Yeah, exactly. And just really quickly, do you see within policies that trade execution sort of framework and specific rules and indicators and tools and techniques? Do you see that with the clients you work with?
Not as often as I'd like to. And I typically advocate for it with the idea that the policy should be revisited based on changes in the marketplace, as well as changes in technology and expertise. I think a policy like this should be revisited every 6 months, maybe even quarterly. But yeah, I'd like to see more detail around that personally.
Excellent. Well, we're just about it's just about time to close the session. I think we have a consensus from the panel that you can time the currency market with all sorts of techniques and tools and market information and maybe some luck, as Michael said. But probably it's not really worth trying to. I think that's the consensus. So thank you very much to everybody for attending this quick half an hour webinar. Thanks as well to my esteemed guest panelists, to Craig Haymaker and to Michael Brown for their expert insights. Hopefully you all found this useful and you've got the answer you were looking for one way or another. If you have any follow-up questions or if you'd just like to talk to any of the three of us, then please reach out to me either on LinkedIn, by a message, by emailing harry@okumarkets.com. You can call me on 0203-838-0250. And to let you know, our next webinar is on Thursday, the 24th of November. This is one you don't want to miss. It's an introduction to currency options for non-financial businesses. So please register now, reserve your spot, as it's going to be really popular, and we're going to be lifting the bonnet on how currency options work. Cool. Well, thanks, Mike. Thanks, Craig. Thanks all for attending, and we'll see you on the 24th of November.
Cheers.
Thanks very much.
Bye-bye.